Well, happy Friday, each and every one of you. Thanks for joining me here for Trading a Smaller Account. I'm Connie Hill, sitting in for Barb today. She is helping out with one of our workshops live. In fact, they're probably having fun right now, even as we speak. And I think they're in Houston this time. And so anytime you get a chance to go to these events, take advantage of it, guys. It's a great opportunity to meet fellow traders, get some personal instruction a little bit, and highly recommended. We're so nice to you. Can't believe how nice we are to you, but we are. In any case, take advantage of that if you can. I hope you're following me on X. My handle is Connie Hill CS, and I'll post educational content throughout the week. Things that I see that are interesting. There's a couple of scans that I like to run that I post about. Try to do that every morning once the market opens up. And so love to have you give me a follow. Now, we have the pleasure of having Mike Fairborn in the chat with us. Mike's a fellow coach and friend. We've known each other for years. He's a great veteran of the market. So as you have questions, go ahead, chat those in. I'll keep my eye on the chat. Mike will help me out. Maybe there might be some things I can't quite get to, but he will help answer those questions. Now, if you're listening to this on the archive, because I know lots of you do, when you have questions, go ahead and type it in the comment section of YouTube. Because I go back and I look at those every day and make sure we get your questions answered as well. All right. Let's go through some quick disclosures, and then we'll get on with our agenda. I've got quite a bit planned for us to do here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for education and educational purposes, information and educational purposes only. Don't consider it a recommendation. We're going to be using the Paper Money software application. It's what you download to your computer. It's the most robust version of Thinkorswim. A little bit different than the web, a little bit different than working off your phone. Nonetheless, great educational product to use as you learn strategies. There are some variances in Paper Money and a live account. One of those variances is that you will not be assigned a short option in the Paper Money account, but for sure the live market can and will do that. Past performance is no guarantee of future results. Typically in here, we'll take a look at the market. We'll talk about strategies, kind of the rules of the class here. And we'll look at old trades we'll follow up on. I had the privilege of being with you guys here last week. So we're going to follow up on the trades that we did then. And we're going to put on some new trades as well. Now, one question I have for you is how many of you feel comfortable using implied volatility to help you determine your strategy? How many of you use implied volatility priced into the options to help you determine a strategy? Well, if you don't, good. We're going to teach you a little bit about that today so you get more comfortable using it, because price, time, and volatility are the key elements of option trades. So we want to get comfortable there. All right, let's go look at our rules for this class, because it is a little bit different than some of our classes. In this class, Barb started out with a $20,000 Paper Money account, and she's been with you in the class growing that all this year. I don't know what we're not going to be able to see that account here, okay? But we're going to use the same rules in my paper trading account. So we won't spend more than $5,000 on a position. We will only risk $400 to $500 a trade. Risk management is just critical. It doesn't matter how big your account is, you still need to manage risk. And so that's the limit, and that's okay. We can deal with that because that keeps any losses, well, hopefully it keeps losses smaller so that we can sustain that account. That means we're typically going to be focusing on intermediate and short-term trades. We're not typically going to be looking at dividend stocks or buying and holding for a long period of time because it doesn't really fit with somebody that is trying to grow that account. We're going to go bullish, bearish, and neutral, should the occasion warrant. So typically when we're bullish, these are the main strategies that we focus on, although if we have time, I'm going to kind of loop in another strategy on us here for this class. When we're bearish, we might look at long puts, long put verticals, short call verticals, and sometimes we'll discuss iron condors and calendars. Okay, it just kind of depends what we're seeing here in the market. All right, let's jump over. Question here saying 5K in a position. Because our account is only $20,000, we would not want to put more than $5,000 into any one position. Okay, meaning spending that would be what, 25% of our account on just one ticker symbol. Okay, that's the limit. And I think Barb even backs off from that a little bit. Okay, but those are the guidelines that we're going to work with. And when we have those guidelines, sometimes it limits the strategies we can use, and that's okay. All right, that's all right. Let's hop over to Thinkorswim. I think this is the window I want to start out on. Just kind of looking at what's going on with the S&P. On the S&P, this is just a 3-month chart. We kind of are seeing a little bit of sideways activity. Okay, that blue line is my 10-day moving average, simple, and the red line is a 30-day moving average, simple. Okay, oops, I won't zoom in here. I was trying to make my drawing tool work, but I guess it still doesn't like me today. In any case, there is a potential reversal pattern on here, okay, that we've been seeing and just kind of being aware of. Doesn't mean it's going to happen, whatever, but we're seeing a shoulder here ahead at this higher point. Then we've got another shoulder, and sometimes we'll see 2 shoulders. Could be that we're seeing 2 shoulders there. It's a reversal pattern, which means market's running out of steam. It's kind of run up as far as it's going to. It tries to make new highs over here, doesn't quite do it. But you know what? It's really not that far. If I go up here to the tippy top here, it's not that far off the high, quite honestly. It's just a little ways below it. In any case, we're watching for it. Somebody that might be wanting to trade that pattern would wait for a break of the neckline, which is this gray bar down here where there's some really good support down here between these 2 bottom points. So we watch for it. We see if it happens. Right now, it just really hasn't materialized, but it does put us kind of in a churning action where the market's going a little bit sideways and you're like, man, it's not going up a whole lot. It's not going down a whole lot. And so we want to adjust what kind of strategy we might want to use there. Okay. The NASDAQ looks similar, although I'd say the S&P has been stronger than the NASDAQ. The NASDAQ also has this head and shoulders pattern. Maybe you might see it a little bit better if I give us maybe say 6 months to look at. Okay, where if you're following my mouse here, here's the first shoulder, up here's the head, maybe a little shoulder here, but definitely more prominent shoulder over here. Same thing. We want to see it break down through support to let us know that, okay, this reversal pattern, yeah, market is really going to go bearish. But we're not there yet. We're just watching to see if that happens. There's a question here. Chris says, 5,000 in stocks, not option contracts. When we're talking about what we'll allow ourselves to do in this account, you could theoretically use option contracts as long as you have that risk limited to $400 to $500. Typically, I'll go for the $500. Okay. If you can meet both those parameters, great. If you can't, you want to make sure you can keep both of those rules so you can keep your risk in check. Chuck has a question here about, is it because it's the end of the year? Maybe I missed an earlier question from you, Chuck, as far as is what because it's the end of the year? Not sure what you mean by that. Give me a little bit of context there, okay? All right. I've got on the screen, I mentioned the 2 moving averages. We've got our implied volatility. Market right now, at least on the NASDAQ and the S&P, seems to be taking a little bit of a bounce. Our implied volatility, which we're going to talk a little bit about volatility in general, has been a little bit lower. Like on the NASDAQ here in the last 6 months, it's kind of near one of the lower ranges. What does that mean to you as a trader? Well, it means that maybe the market isn't quite so volatile. Maybe options are not going to be so super pricey, but it will depend on the individual stock, and we'll take a look at that here as well. Chris has given a clarification. You mean the $5,000 position would be for buying stock and $500 on option trades? So the rules here, Chris, are many of our option trades, we will not use $5,000 because in that case, we might have to risk more than $500. Okay, and so we wouldn't be compliant with that rule. But if there was a scenario where you did say you're going to put $5,000 into an option contract, maybe you go long an option, okay, maybe you don't do a vertical with it or something, and you're spending that amount of cash, yeah, you just got to make sure that you're not risking more than $500. And it's a little bit tough on a $5,000 price tag, but it's a little bit easier when it's in increments of 100. It's a lot easier to manage your risk at those levels. So I hope that makes sense. Okay. Very good. Kim wants to know is my potential, or what are my thoughts on the potential inverted head and shoulders on the indexes and their neckline at the last high? Well, we'll just look at the NASDAQ here. The thoughts are we see the pattern. We see the shoulder, and it's not an inverted one, it's a regular one. An inverted one comes at the bottom of the downtrend. Okay, so we've been in a steady little uptrend. So this is definitely a bullish trend that we're seeing. So my thought is we see the pattern developing. We don't know if anything's going to come of it. We're watching to see if anything does come of it. So far, it hasn't broken the neckline. That would be down here about 24,180, something like that. Okay. It hasn't done that. If it did, we'd be all over it, right? Implied volatility would be spiking here. Would be very aware of that, would probably change our posture from looking for bullish type trades to, whoa, we've got to be defensive here. We got to be, maybe do some hedging in the portfolio, maybe look at some bearish opportunities, but you don't do it till you see it. You got to trade what you see, okay? You can't trade what you think might happen, what your gut says, or what you're afraid of. You have to trade what you see, okay? So hopefully that makes sense. All right. Let's do this. Let's look at the trades we did last Friday. Okay, this first trade, it couldn't have worked out any better. Oh, I mean, it could, but quite honestly, it performed for us really nicely. What happened? We looked at Merck. We did a short put vertical here. This was Friday. It was in the morning. I don't remember exactly where we were in this candle that morning. Okay. We sold it. We brought in, I'll have to go look at how much we brought in there. I think we brought in 32 cents on that credit, and we did 7 contracts. Okay. So we put it in, and guess what happened? Monday morning, like 30 minutes after the market opened, it took our order. All right. It let us buy the spread back, and we were out of the trade, lickety split. We come over here to the monitor tab, account statement on Merck. And if I open up our trade history, there's our 32 cents we brought in. We bought it back on Monday at 8:01 Mountain Time. Okay. For basically what's that? 24 cents. So times 7 contracts. It's a small gain. It's like a little, maybe a little bunt to the first base, right? A little hit to first base. Not a big impact on our account. We gained $168 on it, but if you had a few of those during the week that actually executed for you pretty quickly, those little wins can stack up. Now, in this case, has it really gone much further? It hasn't really gone a lot further. I mean, it is up a little bit, but if we were to look at this, I'm going to go back here. If I were to say, okay, do the same trade, create a duplicate order, what's it doing now? It's down to about 9 cents. Okay, so time to cage just working for us. Happy campers are we. All right. Next up, Adobe. We're going to let Adobe work. Let's show you what we were looking at here, though. And leave that open because we're going to use it. Here's our Adobe trade right here. 335. 340 short put vertical. We're short the 340 strike price. We brought in a whole $1.25. In this case, because the risk was 5 minus 125, we could only do 1 contract, okay, to keep our risk where it needed to be. So we brought in 125. That's the most we would make in that trade. It's decayed a little bit this morning, actually. So we're up on the trade about $17, but quite honestly, the stock just has not moved a whole lot, okay? We've got time. It's not going to expire till, the options expire January 16th. We got in on a flag breakout. And on a flag breakout, typically we're looking for some sharp move up after it breaks out of the flag pattern. We just haven't had that kind of follow through, which is okay. We're still doing okay in the trade. Our short leg here's 340, and it's clearly and easily been staying above 340. It just hasn't moved a lot. If this thing were to start to move, then we'd start getting closer to locking in the gains on this trade. Okay, so what are we going to do? We're going to let it work. Now, I am also going to follow up with you on a trade we didn't do in this class, but we did the day before we had our class. This happened last week on the 11th. We did it in our selecting an option strategies class, and we did 2 different trades. I think it's relevant for you in this class because you can see maybe a couple of different approaches. One we could have done in the class, one we wouldn't have been able to do in the class. Okay, so let me just kind of show you what happened, what we were looking at, and run through the numbers. Lululemon, I think that's how you're supposed to say Lululemon, had an earnings announcement out. Now, trading earnings can be speculative, and not everybody feels comfortable trading over earnings. They don't. They might like to wait for the news to come out and then put on a trade. There can be, as you get a little bit more seasoned in the market, there might be some opportunities that you're like, yeah, I want to take advantage of this earning announcement because in this case, it had tremendously high implied volatility. Okay, the options were really crazy expensive. So we put it on right here, and then they announced their earnings that night. The next day, man, this thing gapped up. Okay. It closed here at 187.01. Next day opened at 204.58. So it made about 30 points, a little bit more than 30 points in that jump up here. Turns out we got out of the trade, but I'm going to show you what happened. But you got to know, okay, there was this big gap. It went the direction of the trade, but it could have easily not gone the direction. They could have easily laid an egg, right? They could have not done well or not had a favorable reaction to what their news was. Okay, a little bit different class, but let's show you what happened here. If we go over here to the account statement, we've got Lulu here. So in our trade history, we have the first trade that we did was that we could have done in this class because the risk was there. We sold a short put vertical and brought in a 170. We only did one contract, so we're doing a couple. We're going to compare. And that would mean our risk on that trade is 330. We're risking 330 to make 170, but we do so because it's a higher probability trade. In this case, 330, since that's the risk, that's why we could only do the one contract. Okay. The other trade we did was a diagonal. Now, it's not on the list of trades that typically gets talked a lot about in this class because sometimes they're expensive and they don't really fit for a smaller account. However, sometimes they might. But in this case, it wouldn't have. Lulu's too expensive for that. But we did a long call diagonal. And if you're not familiar with this strategy, a diagonal is where we're working with 2 contracts. We're selling the front one. Typically, in this scenario, it was because it had a lot of implied volatility, and they were going to announce earnings, and we knew there'd be a volatility crush, and we wanted to try to capture some of that premium. Okay, and then we bought a longer dated option that expires a week later, which would have been today on the 19th of December. Okay, it was more expensive of a trade. It was $835. Okay, but with that pop up, guess where it went to? It went. Amazingly, it doesn't happen very often. Amazingly, it went to where our short strike price was at 205. Okay, it just popped up there. And that actually put it in a sweet spot for a long diagonal because the peak point of profit is near the short strike price. So we were able to sell it very quickly. Let's see how quickly we sold it. This one, the vertical, we just let it expire worthless. There was nothing to do. Okay, it was so far out of the money and the options weren't really trading there, okay? The diagonal, we said, okay, after 8 minutes, we saw the pop. It was right in that sweet spot and was staying there. And we're waiting for some of the implied volatility to kind of drain out of it. But it got to a point, there was a decent profit. We said, let's go ahead and just take it, okay? So we brought in 1875. So we subtract our costs that are at 835. They gave us a net on that particular trade of about 1,037. Now, the reason I wanted to bring it up is because sometimes some strategies do pay better than others. We don't know which strategy is going to work out the best. We really don't. We maybe don't have expertise in every strategy. But the idea is you can kind of do some mixing and matching as you get a little more tools in your arsenal. You do some paper trading so you get comfortable with it. Because theoretically, could you do a long call diagonal in your class account? Yes, and hopefully we're going to look at one today. All right. Bruce wants to know about a triple witching day and what happens at the end of the day. Mike, I'm going to let Mike answer that question because he's well versed in that. Basically, lots of options expiring today. Okay, Dragon was having a problem with sound. Looks like your sound is back. Sounds good. Kevin's trying to help out there. All right, I think we are up to date. Debbie didn't have sound for a moment, so I hope it's been restored to all of you. If it's not, my producer will get in my ear and say, we got a problem. But I think we're okay for now. All right. Those were follow-up trades. Hopefully, you're getting comfortable with a lot of strategies that you were able to follow along, because this is not a beginning level class. It's an intermediate level class. So we assume you know quite a bit about options. Maybe you don't think you're an expert or anything, right? But you're able to follow along. Today, we're going to look at some new trades. Some of you are going to go, the question usually comes up, where did you find this? Where did you find it? Oh, I want to know where you found this particular trade or stock. The ones we're going to look at here today actually came off of this watch list. It's a dynamic watch list that comes from a scan that I created called my Early Morning Movers Bullish Scan. And I like to run it in the morning if I can. Sometimes I'm teaching, so I kind of have to wait a few minutes, but I'll run it and it gives us an idea. We're looking for stocks that are trending up, at least in the last month and the last 3 months. They have to have a certain volume, which is, I think, about 1.5 million, maybe 2 million. I can't remember. I think it's 1.5 million shares on average. And then we're looking for a move on the day. It has to be at least 1.5%. Some days we get a lot of results and I change it and I go, okay, let's just look at the 2.5s and better. Those are moving a little bit more. And I do post those out of my X account. If you're interested in following along, you can see some of the results that were out there this morning. Okay, but that's where these came from. When we go over to, we'll go over to our Trader Talks channel in a minute, and I'll also show you where I teach you the scan if you want to learn it yourself. Just run it on your own, okay? Yeah, Brian wants to know, how did you create the scan? I made a video so that you can go and build your own, run it as often as you want. It's not public, but because I'm sharing it out on our YouTube channel, it is public, right? If anybody knows where to go, I'll show you where to go to get that. All right, let's get our first trade I want to take a look at here. And it did come from moves that we're kind of seeing this morning. I've got a few that I want to look at here. So we're going to kind of maybe see if they still look good. If they don't still look good, we're going to pass on them. All right. Pan American Silver Corporation. What's been going on with metals and mining and gold and silver and copper? They've been having a nice run, haven't they? Okay, so this is a silver mining company. I'm going to take a quick look. I do not think they're foreign, but I'm just going to look real quick. I guess maybe we would consider it, I don't know if that's British. I think that's British Columbia, Canada, as opposed to Washington. Okay, so I guess they are a foreign company. Usually it'll have like a little ADR up here on foreign companies to let you know that they are a foreign company and they have extra risk, right? They have country risk, they have currency risk. Their reporting requirements could be different. Okay, so you just want to be aware of that. Now, in this case, what kind of an entry are we seeing here? Last week, we talked about nailing a good entry, right? We talked about being on time when the move is made. So you're on to the party on time, right? I've got a party tomorrow, man. I am going to be on time. Of course, I better be because I'm bringing the food. In any case, we had a nice little run up, a little bit of a pullback, like a 3-day pullback. And in this little pullback, the stock went the lowest on, I'm going to zoom in here a little bit more, on this day. We might look for a close above the high of the low day to let us know it's a big enough bounce. Now, let's see, the high here that we needed to close above was 50.25. Did it do it here? It didn't. It was a few cents short. Is that right? Actually, it did. I take that back. It was the high was 50. Well, the high was 50.60, but it didn't close above this high. So NOCA hold here. We can just look at it here and go, oh yeah, NOCA hold here. Finally today. We're not at the end of the day, so we don't know if it's going to close there, but at least it's doing a trade above the high of the low day. Finally, there's a little bit of a signal there that some traders might like to use. Now, some people might want more confirmation. That's possible. But for some traders, they're like, okay, yeah, I think I like that kind of an entry. So let's now, let's back up here. I want to look at a one-year chart, and I want you to look at the implied volatility here throughout the year. There are going to be periods of time though when we see stocks having higher implied volatility. Sometimes as they're running into earnings might run up, or big news. When the market is falling and the stock is falling, a lot of time that can generate some implied volatility. Look at this here recently, though, on the implied volatility, how it's ramping up really high there. The stock isn't dropping. It's not scary times, but big movements are happening. Okay, and so when we see those big movements, that can increase implied volatility. So, you know, the highest of the year, I'd say, was maybe right here at 0.68. Right now, it's at 0.57. So it's at a higher range. What does that mean in terms of options? Well, it means that they might be a little pricier. They might be a little juicier. It might help somebody maybe lean more towards maybe a selling strategy than a buying strategy. But as we come over to the trade tab, there's a couple things we're going to look at here as well. And that is over here on the far right side. Hopefully you're getting and hearing this and seeing this in classes a lot, that you know this number here that's just to the right of my arrow, that 88.21, is how much implied volatility is priced into the options that are going to expire. These particular ones expire today. That's a lot of implied volatility in there. That's not, yeah. We dropped down to, and actually it looks like they've got a couple of different, there's some irregular contracts here. But we jump down to the regular weeklies, it drops down to about 50%, 56%. Now, some people might consider that a little bit higher implied volatility, which would make the options a little bit, I'm going to say, beefier, a little bit juicier, a little bit bigger. And so some people might prefer a selling strategy over a buying strategy because of that. Now we're going to use the January 16 options. It has weeklies, but they're not super liquid, okay? But look at the open interest here on the call side. Got thousands of contracts, not as many on the put side, but you know, they're still fairly decent, and the spreads are relatively contained. You know, $2 by 210, sweet. We like that. Only 10 cents difference. And many times we can get filled at the midpoint price here. Bruce wants to see a broken chart. I'm not sure what you mean by that, Bruce. A broken chart. Oh, Avgo? Something like that. Well, we're not talking about Avgo today. It wasn't in my list of examples. Okay. What would we think there? Would we, just kind of for yourself, would you favor a buying strategy or a selling strategy? Some people might favor that selling strategy just because of the implied volatility here. Now, in this case, the strikes we were looking to do, we'll see if this still makes sense, was 49.47. Let's see. Yeah, 49 is a 31 delta, right? Some traders like to sell 30-something deltas or high 20-something deltas. Stocks have a lot of implied volatility. Sometimes you can get a 20-something delta that pays you, you know, nicely. Okay, let's do this. We're going to do the 49. We're going to spread it out by $2. We're going to go 49.47. So we're just going to say sell vertical here and change this strike price here to the 47. And I'm going to lock this. Okay, that's a 60-cent credit. Now, with your rules, and if you're familiar with doing credit spreads, is that a good return? Is it something that you would like go, oh, I like that? Or would you go, oh, it's too puny? Okay. All we do is take our 60 cents, our max theoretical gain, divide that by our max theoretical loss, which is going to be 2 minus 60 for $1.40. 42%. 42% for 28 days. Yeah, a lot of people might like that. Now, in this case, because the risk on this is just 140, how many contracts can we do? Boom, boom, boom. Oh, look at that. We could do 3 contracts. Okay, so we're going to. Is that right? Yeah, 140. 140 is our risk. So yeah, we're going to be able to do 3 contracts. So we're going to bump that up. We're going to change this to a first trigger sequential. And something some traders like to do is they say, I'm not going to treat this like my toothpaste. I am not going to try to milk every single cent out of that 60-cent credit. We're starting with a healthy credit to begin with. When we get a chunk of it, let's be happy, take our profit, and get out. Just like what happened at our Merck trade that I showed you. It didn't even really move that much. We had time decay over the weekend. And of course, first thing on Monday mornings, prices are popping around. And so sometimes you can get a fill. Okay. So we're going to say, yeah, if we get a chunk of it, let's be happy campers and be on our way. Now, you get to decide what is a nice amount to you. When I ask this question in my classes, some will say, I like 50%. If I can get 50%, I'll take it and go. Move on to a new trade. Remove that risk. Some people might want something different, right? You might be different. For our purposes today, we're going to go for 70%. Okay. If we have 70%, that means only 30% of our 60 cents is there. So we're going to multiply this by 0.3. And that says go buy it back at 18 cents. That's pretty similar to what we had on our Merck trade. So let's create an opposite order. Let's put in to buy it back at 18 cents. There we go. We're going to make it a good till canceled. We're going to send it in. And really, it's going to be a time of patience. Let time decay. It needs to do what? It needs to, we would love for it to stay above 49. Where's 49? We'll zoom in here. 49 is, it's kind of right where that 10-day moving average is. It's at 49.01. That is where we would want it to stay above. So we've got over $4 of leeway. Right now it's at 52. It could come back $4, right? It could come back $4, would be just fine, even if it sat there. And maybe it went sideways the whole time. In this case, because of the uptrend, it's trending really nicely above its 10-day, our expectation is probably going to move, which is good. So hopefully we can try to lock in that chunk a little bit sooner. Okay. Let me see what these questions are here. Alexander said, well, I thought we were doing 4,000 a trade. You can do up to 5,000 in a trade with these rules. You can do up to 5. But for example, on this, if we were going to put $5,000 into that trade, but our risk, we're risking more than what we are having to gain in this case, right? We're risking, let's go back here. We are risking $1.40 to make 60 cents. All right, which is $140. But we're not going to we're not going to go out there and do 50 contracts. Okay, no, that would not fit. We would go with the, hey, we're not going to risk more than $500. And if we have 140 that we can risk on this trade, that would be if everything in the world went wrong and an options expiration, we lost at 140. That can happen to us for 3 contracts, would still be under $500. Okay, so that's why we're doing 3 contracts. Usually that $5,000, when we use that, usually in this class, it's because we're doing a stock purchase with it. But we don't want to spend more than $5,000 with it. And of course, we would position size it. Okay, I hope that clarifies those of you that are trying to say, hey, what does that rule really mean? Now, Jeff says, when you sell a call or a put or a call, can you be assigned at any time? The answer is yes. The moment we hit submit here, we're on the hook. We are on the hook to have the stock put to us at $49. Now, we have our hedge leg that says, well, we can go out and put it to somebody else at 47. We've already got our credit of 60 cents. And so the difference between those two would be your theoretical max loss. But if it's not deep in the money and you've got lots of contracts like we're working with here, there's a decent number of contracts. I'm trying to get back to the 47, 49. There's a decent number of contracts. We're not doing that many contracts. We make a little teeny spot in the big pool of contracts. It's not as probable, but it is possible. Yeah, it absolutely is possible as soon as I hit that. But traders might not have incentive to, on the other side of the trade, to actually exercise their rights if it doesn't pay out materially, meaning if it's not below that strike price. If it's above it, they don't really have that incentive to do so. All right, we're going to send this off. Not sure if I'm subbing for Barb soon, but I'm going to put it in, I'll just put it in our unallocated section. Maybe I'll go back later and put it in a different section. I'll make sure we get filled on this particular one. Let's see here. Didn't get filled right away. It looks like it's down a little bit. We'll see if it goes back up to 60. If it doesn't, I'll go back and change it. All right. Somebody's got a question here. The premium and the price should dictate buy and sell strategy. IV is a gimmick. Gimmick? No, I mean, the price, time, and volatility are the main components. And the price of an option is determined by those things. Implied volatility, it's real. It has to do with how much fluctuation is there in the stock. You know, if we have a stock out here and it's been like $45 or between, say, that's probably not realistic, let's say between $45 and $48, and it's been that way for 6 months, there's not a lot of implied volatility in there. There's not a big expectation for movement. It's been moving very little, so it's not likely to move very small. Or it's expected to move small, not big. One of the things I'll use on my early morning movers is I will use a column here. It's a 1 month return and it's a 3 month return on these stocks that are on the watch list. And it gives me an idea, is this moving a lot this month or this quarter, or is it not? Okay, so on this one, Pan American, for the month, it's actually up 43%. It's moving along. It's about the same in the quarter, which wouldn't lead us to believe that, wasn't really doing a whole lot prior to this month. Probably was sitting there kind of flat. And we could go back and look at the chart. Curious PT says, do we have enough cash in our account for assignment if we sell these 3 spread contracts? Our intent is not to be assigned on them, okay, because of our hedge leg. Our hedge leg is our protection that we can go out to the marketplace and do what we need to do for a much lower price than whatever the going rate is. Okay, that's what this 47 leg assists us with and gives us that buffer. Okay, but some people do get scared off by that, going, well, if I were put 300 shares of stock at $49, I don't have enough money for that. And the reality, as you go out, paper trade this, test this, you'll see that because of our hedge leg, we don't have to. There's no reason for us to. Okay, even in the event that maybe we were assigned, fine, we'll exercise at 47. We've already received a credit, whatever that costs us, and the difference of whatever the credit is that we received, it's going to be significantly lower than that. Okay, that's why I think it's so important to paper trade these strategies so you get a feel for them, so you get comfortable with them. Okay, to see if maybe it's a strategy you want to use. You know, our first disclaimer says options are not suitable for all investors. Okay, that very well, that maybe that fits you, maybe it doesn't. Let me show you where that scan is. And I want to make sure we get to one more trade before our time is up here. I'm going to let Mike handle kind of some of the rest of those questions there. Okay. Come over here with me to our Trader Talks channel. This is where you can find our playlists of our class. This is where you can see what's coming up today. After this class is over, we're going to have advanced charting techniques. Cameron May teaches that class. He does a great job with it. You don't have to be an advanced person necessarily to understand what he's teaching in this class. He makes sure everybody can follow along, even though techniques he's talking about are a little bit more advanced. They're going beyond support and resistance and those types of things. Okay. One thing that I was going to show you is on this bite-sized content. Okay, I'm going to go to the play all list, and this is where I created a little video to show you that scan. Okay, so you click on the playlist, you see all the little videos that we're putting out here every week. And we need to see, let me scroll down here because this was put up here quite a bit ago. The one that you're going to look for is called Instant Watch List Bullish. It's a 3-minute and 27-minute or second video. Teaches you how to create that scan. I'll mention some variations of the scan as well. But you could go out there, learn how to build it, save it on your platform, and then whenever you wanted to run it, you could run it. You don't have to wait for me to release some results. Plus, I kind of filter the results that come back based on a lot of times what industry group is well represented that we want to pay attention to. Okay. All right. One last trade. Let's get back here. We don't have a ton of time, but so we might not squeeze in the whole trade, but let's do our best here. Let's look at Intel. Intel is on this list somewhere, all right? Semiconductor stock. What's been going on with it? Well, it had a nice new high up there at 44. Had a little bit of a pullback here, right? What's it doing right now? Well, it didn't form a lower low, okay? It bounced before it got down here to the previous low around 33. It bounced here about 35, 36, okay? And so, you know, it's had this pullback. I wouldn't necessarily call it a flag, but it has been a pullback and it hasn't gone lower. If it had gone lower, we'd call it a full retracement, okay? But it still is in an uptrend. So with this particular one, here's our low day. Earlier when I was looking at it, man, it was looking like it was going to trade above our high of the low day, which is 37.84, and we are so close right now. It's at 37.44. Maybe by the end of the day, it'll do it. We won't be around sitting here with each other to know if that really occurs or not. So we're going to go ahead and take some action on it for our class trading example purposes. On Intel, we are going to look at implied volatility. It's kind of high. Okay, it's not super high. What I was thinking to do was to do a buying strategy with it. Okay, look at the open interest here, guys. Look how lovely 37,000 contracts is, and the spread 4 cents. That is just like delicious to be even thinking about. Trade I was going to put on here is actually going to be a long call diagonal. I was going to compare it to a long call vertical, but we don't have the time to do all of that. So this is the trade that we're going to put on. We're going to sell a front series contract. So we're going to come in here to the January 2s. We're going to sell the 38.50. Right now it's about a 39 delta. And then we're going to buy an option out further in time and further out of the money. And we don't, well, on this one, we're not going to go a ton far because it's not like Intel is like racing really big right now. So maybe just a small move is what we want to capture here. So we're going to come in here. We're going to do a right mouse click. We're going to say buy diagonal right here. And we're going to keep that short leg, the 37.50. We're going to change this 38 to, let's see here. I think I might have grabbed the wrong one. I wanted 37 even. I wanted the 37 even. So I clicked it a little bit wrong. We'll try this again. You start with the short leg in the month you're selling. So let me get on the right one. And we're going to do buy diagonal. Now we're going to come down here. We're going to tweak it. Okay. We're going to change this to 39 strike price. And we're going to do this in the January 16 expiration. That's a pretty low net debit. With calendars and diagonals, it's a little hard to know from the front of the trade what's the absolute max risk. But there's kind of a sweet spot that we would love the stock to go to. If we go to our analyze trade, over here to the risk profile, we actually got 10 on here. Let me delete that. we could do 10 contracts in this class easily because that's such a low debit, but we would be looking for just kind of a small little move, and peak profitability is up here at that 37 short strike price that we sold. Okay, that's where peak profitability is. Don't count on peak profitability. It's really hard to get. So then you might go, well, let's, maybe if it goes somewhere between 36 and 38, there's some decent profitability. Okay, and we might like to try to capture it if it goes here. But if it goes down, if it goes up, that's our peak. But if it goes way past and gets really, really high really quickly, 41, 43, we are going to be losing money on the trade. So we just need small move with this particular one. All right. That's to stretch you a little bit here. I'll throw it in our account. I will do 10 contracts on it. And if I get to follow up on this in either one of my classes or in a class for Barb, then I'll go ahead and share that information with you as we track it. All right, you guys, I am out of my time. You've been fantastic today. I didn't see a survey, but if this was a helpful and good class for you today, go ahead and hit the thumbs up button on the way up. Follow Mike and I on X, and make sure you subscribe to our Trader Talks. Cameron May will be here right at the top of the hour. We'll see you then.